I've been at the AMA conference before and always appreciated this format. It's a great one, and I hope it's going to last for many, many years to come. Thank you, Stephen, for organizing this, and Howard as well, and all the others who were involved. So maybe apart from all the positive things about me we've had about me from Stephen, maybe another thing about myself. I'm a PhD candidate in practical philosophy at Gothenburg University. And my PhD project is to evaluate monetary systems using established theories in political philosophy. I think this is an important project, at least for two reasons. The first one being that monetary systems are a really neglected topic in political philosophy, yet they have huge impacts on, like our political communities, and hence somehow a subject area in political philosophy. And that's just a research gap in my discipline. And secondly, the evaluation of monetary systems is often perceived as a sort of economic topic to be handled by economists. Yet I think monetary systems have consequences on non-economic priorities, which many of us care about deeply, such as democracy, distributive fairness, equality of opportunity, and so forth. So that's where I think, political philosophy offers a principled way of talking about these things, and I hope to demonstrate this a bit in the course of my talk. So in the work I'll present today, I take the most influential theory in political philosophy, and I use it to evaluate a monetary system called sovereign money, which most of you will know. My talk will have 4 parts. In the first one, I'll introduce you to my discipline a bit, political philosophy. I thought I'll take some time on that because presumably it's not known to many of you. I'll introduce some of the targets and the methods that this discipline uses. Secondly, I'll introduce you to Rawls's political theory, which is the most influential theory in political philosophy. Then I'll introduce sovereign money. And finally, I'll evaluate sovereign money using Rawls's political theory. I'll conclude that a version of sovereign money meets all requirements of Rawls's theory of justice, and that consequently, sovereign money reform is a requirement of Rawlsian justice. Just so you know, I'll have 1 slide for each part of this presentation. Okay, so let's start by having a short introduction into political philosophy. So the targets that political philosophy strives to achieve is to provide a convincing answer to the question which political institutions we should have. Yeah, finding answers to this question, I think we all agree, is very important, because in a way, the future of our political community depends on it. However, many people think that one cannot have a reasonable discussion about a question like this, because anyone can say anything, and there's no way of verifying or falsifying certain answers by reference to some kind of empirical reality, as the empirical sciences have, for instance. And that is true. However, what us political philosophers think is that we can at least narrow disagreement on which institutions we should have, or under certain assumptions, we can discriminate better from worse institutions. And the sort of generally, the most used method for doing so is reflective equilibrium. The targets of reflective equilibrium is to develop a political theory here that is sort of a general answer to the question of political philosophy, which political institutions we should have. It's an abstract statement of what political institutions need to be like in order to be desirable. Yeah. So one example of such a political theory is Rawls's political theory, justice as fairness, which I'll introduce in the next section. Then to tell whether a political theory is good or bad, we check in principle whether the institutions that it recommends are in line with our moral convictions. That's the general principle. And when we develop a moral theory, we start with collecting a set of moral convictions about political institutions, that we hold on firmly to, that are fundamental to us. For instance, we might, have moral convictions that political institutions should be democratic. We might have a fundamental conviction that political institutions should guarantee our personal liberty and integrity, should guarantee the rule of law, and should protect property. Or maybe they should also, ensure equal opportunities for people of equal talent. All those are fundamental convictions that many people share, that many people think, are necessary or are really important for political institutions to achieve. And then once we have this sort of set of moral convictions that we start our theorizing with, we generalize them in some way, and we obtain a political theory that is sort of an abstract statement of political institutions, or of what political institutions should be like. In the next step, we sort of apply the political institution to concrete institutional questions like which monetary system should we have, as I'll do later on, and we get an institutional recommendation. Like in my case, I'll get sovereign money as an institutional recommendation. What we do afterwards is basically to test the institutions that we get as from applying a political theory to a particular question against our considered moral convictions, to find out whether the recommended institutions does what we sort of wanted to do, or whether maybe it violates some demands that we hold for political institutions. And if the institution that is recommended by the political theory fits our convictions, then it counts sort of in favor of the political theory. But if the institution that is recommended by the political theory doesn't cohere with our moral convictions, then there may be two sources for that kind of divergence. The first one is that we may have left out certain moral convictions about political institutions that we hold on dearly, and we can sort of include those moral convictions that we had left out previously and sort of alter the political theory up until it reaches a higher state of completeness. The second possibility, or the second possible origin of a divergence between recommended institutions and moral convictions, is that there might be incoherencies or contradictions within our convictions. In which case, we can basically try to adapt our convictions, such that they get in line with the political theory. This is what happens when, we are convinced by arguments about political questions. It's a very commonplace experience. And in political philosophy, we do this process for a variety of institutional questions over and over again. We refine a political theory, and the less we find need to alter the political theory after this kind of iterative process, the more confident we can be in the political theory, the more confident we can be that it captures our fundamental convictions about how political institutions should work. So what this method is supposed to do is to identify institutions that those who share basically a fundamental set of political convictions can agree upon, or at least that we can explain the institutions we recommend to people who share certain moral convictions with us, in a way where upon reflection they are likely to agree. A limitation, of course, of this sort of method of political philosophy is that we'll not be able to solve disagreements with people who have very, very fundamentally different moral convictions from ours. Good. So in the next step, I'll introduce you to the most prominent contemporary political theory, which is John Rawls's Justice as Fairness. And then in the final step of the presentation, I'll apply John Rawls's political theory to the question whether we should have a sovereign money system. All right. So now for John Rawls's political theory. John Rawls's political theory is called Justice as Fairness, and it claims that the prime requirement for political institutions is that they need to be just. And in order to be just, political institutions need to satisfy two principles of justice, as he calls it. The first principle of justice requires that political institutions need to protect a set of 7 basic liberties, which include, for instance, the freedom and integrity of the person. They include political liberties or democracy. They also include the freedom of association, the rule of law, and a couple of others. Then the second principle of justice entails requirements for social and economic differences. It comes in sort of 2 subparts. The first subpart sort of states that social and economic privilege should be accessible under conditions of fair equality of opportunity. And the second subpart of the second principle says that social and economic differences must be to the benefit of those who benefit least from them. Yeah, and the first of these 2 principles has lexical priority over the second. That means there cannot be any trade-offs between the two. So a different way of saying that is that no gain in the second principle of justice can justify a loss in the basic liberties in the first principle of justice. Yes, so if that was a bit quick and stuff, that doesn't really matter, because it's I'll only be talking about the first principle of justice later on. And what I'll be trying to show is that a sovereign money system meets all the requirements of the 2 principles of justice once certain amendments are made, but I'll focus on the first principle of justice. Yeah, this is just basic liberties. Good. So before heading any further, I think it's really important to have a look at the assumptions of Rawlsian theorizing, because I sort of take these assumptions over into my work. Right. So, like, the first assumption I'd like to mention is full compliance with the laws and reasonably favorable material circumstances. Yeah? The idea behind these 2 assumptions is to imagine that we've settled these things that are probably pretty universally agreed to be problems. So we imagine that we've settled the issue that there's incompliance with the laws, and we imagine that we've achieved a favorable material sort of situation. That's to say there's no economic hardship, so that's not an assumption that's an assumption that contemporary Western democracies do meet. And you know, like, once we make these assumptions, we focus on the more sort of contentious problems that arise only once these assumptions are fulfilled. Good. The next sort of restriction of Rawlsian theorizing that is really important is that it's only concerned with the basic structure of society. That is, the main political institutions of society. And it implies that in Rawlsian theorizing, we are not concerned with the justice of associations within the basic structure. That's football clubs and churches. Yeah, these things are called local justice, and they are not part of justice as fairness. But the thing that's even more important for the topic at hand is that we assume a closed society. That's to say, we do not care about international relations. Yeah. So in the realm of monetary systems, of course, that's a hugely unrealistic abstraction, but it comes from Rawlsian theorizing. And so if you want to stick within that tradition, then you have to make the assumption of a closed society that doesn't have international relations. Good. The third thing I'd like to mention is public reason. So public reason is the idea that we should conduct our discussions in simple and uncontroversial terms that supporters of different comprehensive doctrines in society can agree upon. Yeah. So a side target, which if I'm successful at this, maybe I can achieve, is to show that, while the specifics of monetary systems are really complex, I think we can meaningfully talk about the basics of monetary systems in simple and relatively uncontroversial terms. Yeah? In my opinion, monetary systems are a topic that is fit for discussion in the public forum, and that doesn't have to be confined to the technocrats in central banks. Good, so this is a basic introduction to Rawls's political theory, and we'll now go on to sovereign money. Quick introduction to that, I think most of you know it. So before getting to the core of the matter, I'd like to put forward some definitions that I use. I define as money any generally accepted means of payment. The monetary system is a public system of rules determining how money is issued and retired. And monetary policy is the pursuit of goals via the monetary system. Now, I'd like to sort of define sovereign money with regards to all of these things. In sovereign money, there are three things which are generally accepted as a means of payment: coins, notes, and digital money. And the definitional element of sovereign money is that only the state issues and retires this money. And everyone else, apart from the state, is prohibited from issuing any money. So this is what I think to be the element that all definitions of sovereign money share. If an actor but the state were able to issue money, the monetary system wouldn't be sovereign in the intended sense anymore. And the main difference, of course, to today's monetary system is that commercial banks cannot create money in a sovereign money system. Good, so this is the definitional core of sovereign money. This will have some kind of importance later on. But to make my conception of sovereign money a bit more concrete, I use the conception of sovereign money proposed by Joseph Huber in his 2017 book. In this conception of sovereign money, there's an independent central bank that decides every time period how much new money needs to be issued, and the government basically gets to spend this money into circulation, or most of it at least. Right. So in this sovereign money system, monetary policy is made by two parties. First of all, the central bank that decides how much money to issue, but also the government makes monetary policy because it spends money into circulation and decides on the first user of new money. Good, so much for a definition of sovereign money, and we'll now get to the third part, the fourth part and last part of this presentation, which is to check whether sovereign money meets the demands of justice as fairness. The method that I'll use here is relatively simple. As we've seen before, justice as fairness requires formulate certain requirements for institutions of the basic structure. And you see some of these requirements here in the first column. So the first three are from the first principle of justice, if you remember. That's the basic liberties. So we have the political liberties, which is sort of democracy, freedom of association, public order, and security. And then the last requirement is fair equality of opportunity and the difference principle, which I've had to abbreviate for space reasons, which are sort of the second principle of justice. If you remember from the slide on Rawls's political theory. Now, the monetary system is one institution of the basic structure, and as such, it cannot violate any of these requirements that justice as fairness has for institutions of the basic structure. Now, to check whether sovereign money meets the requirements of justice as fairness, I undertake three steps. First, I'll ask whether Huber's conception of sovereign money, or Joseph Huber's conception of sovereign money that I just outlined, so I'll ask whether as such it meets the requirement, and if it does, then that's fine, and I basically move on to the next requirement. But if it doesn't, then I see whether there's anything I can do to increase the performance of sovereign money within the sort of definitional core of sovereign money. That means the fact that in a sovereign money system, it's the state and only the state that issues and retires money. Yeah? And then as a final step, I ask myself whether once the proposed amendment is basically in place, whether sovereign money meets the demands of justice and fairness afterwards. The idea behind this methodological approach is to make sovereign money as compliant as possible with justice and fairness, such as to, in a way, evaluate sovereign money in its best light from a Rawlsian angle. Yeah, good. So with that out of the way, we can really start with the assessment. We start with the political liberties. The political liberties require that citizens have a democratic say over the rules and policies of their basic structure. So this is, in a way, what's commonly known as democracy. To repeat, citizens should have a democratic say over the rules and policies of their basic structure. Is this satisfied by sovereign money as I've outlined it? The answer is partially. The democratically elected government gets to decide on the first uses. So here's the possibility of democratic influence, but the central bank decides on how much money to issue, and the central bank is independent from political influence. So the decision on how much money to issue cannot be influenced democratically, just the first use of money. Right, so now we ask ourselves, is there anything we can do to improve sovereign money or to improve sovereign money's performance with regards to the political liberties, holding or not changing the definitional element that it's only the states that issues money. And actually, there's an answer that's pretty simple. We can just assign money issuance to the government. So the government that gets to decide on the quantity of money issued, just like it decides on any other kind of economic policy. After that amendment, sovereign money satisfies the demand of the political liberties. And we can move on to the next normative demand, which is freedom of association. That's the requirement that people should be left free to pursue their priorities in life in cooperation with others. So now we want to ask, is this satisfied by sovereign money, as I've outlined it up to now? And the answer is yes, it is. There is nothing keeping people from associating with others in order to pursue their priorities in life in a sovereign money system as outlined. One of the reasons why I mentioned this here is that I have a long discussion in the paper whether the prohibition of fractional reserve banking violates somebody's freedom of association, but I think I can give a good argument that it doesn't. Good. So we move on to the next requirement that sovereign money has for institutions of the basic structure, and that is public order and security. Public order and security denotes the conditions that are required for granting any liberties at all. And there is one thing that might endanger public order in sovereign money, and that is if government issues so much money that there's hyperinflation. Yeah. So in the case of hyperinflation, nobody wants government money anymore. Civil servants, of course, are not an exception to this. And basically, when civil servants don't go to work anymore, there's nobody to safeguard the basic liberties. So that's why hyperinflation is endangering the guarantee of any basic liberties at all. However, averting this danger is relatively simple. The only thing we need to do is to have some kind of constitutional provision that limits additions to the money supply at some kind of reasonable level, and the problem is solved. We are in full compliance theory. We are assuming that everybody sticks to the law, and so we can assume that the government sticks to these constitutional provisions and does not add more money to does not issue more money than is compatible with the constitutional limitations of the same. Good. So after this amendment, sovereign money complies with the demands of justice as fairness. So now finally, we come to fair equality of opportunity and the difference principle. Fair equality of opportunity requires that positions of social and economic privilege are accessible under fair conditions. And the difference principle requires that the least well-off are as well-off as possible. Yeah, both these principles specify requirements for the distribution of wealth, actually. Fair equality of opportunity requires preventing excessive concentrations of wealth over generations. And the difference principle requires maximizing the income and wealth of the least advantaged in a social system. Now, sovereign money, as specified up to now, presumably already has quite a few positive effects on the distribution of wealth. So there's less speculative investments in a sovereign money system, according to its proponents. And speculative investment is one of the drivers of inequality. And also proponents of sovereign money claim that sovereign money gives more stability because money and credit are sort of separated function, which of course is going to benefit the least advantaged in the case of bank runs and panics. Good. Still, alternative monetary systems might perform better with regards to the distributional requirements that fair equality of opportunity and the difference principles specify. So we might still want to ask ourselves whether we can improve sovereign money's performance with regards to these two targets. And the answer is yes, we can. In fact, what we can do in a sovereign money system is to put the entirety of monetary policy into the service of the least advantaged. Yeah? So we can, for instance, forward all newly created money to the least advantaged, or we can also implement job guarantees as proponents of modern monetary theory, thereby ensuring that sort of both the differential intergenerational transmission of advantage is alleviated, and that the least well-off are as well-off as possible. So in conclusion, what I've argued is that a customized form of sovereign money in which the government makes monetary policy does not interfere with the protection of any basic liberty and offers very potent tools for furthering the distributive goals of the difference principle and fair equality of opportunity. In the end, whether a society that wishes to implement justice as fairness chooses sovereign money evidently depends on whether there's other monetary systems that perform even better. And that's something that I couldn't do, that I couldn't discuss within the confines of this talk. However, in other parts of my work, I showed that the current monetary system violates political liberties. Yeah, it's a definitional necessity in the current monetary system that private banks issue some money, yeah, and whatever quantity they issue cannot be influenced by democratic means in any way, because it's private corporations. So this means that in our current monetary system, citizens cannot take an influence on all the policies pursued by their public institutions. The same holds true, by the way, for a monetary system called free banking, which I also evaluate in my work. And also another drawback of free banking and our current monetary system is that both of these systems offer much weaker instruments to benefit the least advantaged. Good. I think that in conclusion, this establishes a presumption that sovereign money reform is a requirement of Rawlsian justice. And that's what I wanted to tell you. Thank you very much for your attention. I'm looking forward to questions.
Thank you. I just had to unmute. Thank you very much, Georg. That was a wonderful, complete system and a lot of sound thinking there. And Can we open it up to questions?
How do we ask for the floor?
You can raise your hand.
Alrighty.
Yeah, and we have some clapping in the background too. Okay, Andrew, please go ahead.
Yes, thank you. Yeah, I'm a trained monetary economist for many years. I have a fundamental problem with the overall assessment of your proposal. We're in a situation where, so long as there is fractional monetary, you mentioned it, but I don't understand how it answers the question given the system you're proposing. We've got 95% of our money in the United States is basically money created by bank lending, not by printing currency or what have you. So long as there is a substantial banking institutions, it's not just monetary policy that's in the hands of the corporations. You know, we've seen case after case. We've actually had legal suits of banks that discriminate in their lending activity, let's say against Blacks or Hispanics in buying houses, in terms of which supporting minority businesses versus white businesses, and supporting small businesses against big businesses. I mean, the entire system of public policy, when you have a banking system, is basically to give up control to a large extent of how much money circulates. If the banks can also take money out of circulation, be it by choice or otherwise, not lending in a particular situation, they basically remove the power of money in that system. We saw redlining as part of urban development in the United States, where you basically banks would decide just not to lend money into a whole area and basically destroy it because they had other goals in mind for that land, usually to their own advantage. I don't understand how are you talking about eliminating the entire private banking system as part of a defined sovereign monetary to be a positive system? I don't, unless that's what you're going to do, I don't see how those are compatible.
Mm-hmm. Thank you very much. So basically, the idea of sovereign money reform is not to abolish all banks. Absolutely not. What we want to require them to do is basically to fund themselves 100%. Yeah. So a bank can only give out a loan in a sovereign money system if it has taken in the money in the form of deposits beforehand. Yeah. In the current monetary system, what happens is that a bank can give out a loan whenever it thinks that the borrower will be able to repay, by just creating this as book money de facto. Yeah. Right. So this is the difference. Why is this relevant for the monetary system discussion? I think this is so because currently, when banks give out a loan, they create money. Yeah, they are the ones who determine the first user of money, right? And this is not going to be the case in a sovereign money system because the entities that determine the first users of money are purely public. Yeah, there's no private entity in a sovereign money system that determines the first user of money. Yeah. So this, in my opinion, makes it monetary policy. The issuance of money, when you sort of determine the first user of money and determine the quantity of money newly issued. And in a sovereign money system, this is a purely public prerogative. In our current system, as you rightly noticed, this is a prerogative that is largely exerted by the banks. Yeah, but again, there's absolutely no idea of abolishing banks. Banks fulfill a really important function in maturity transformation. We want to keep that. The only thing that we want to take from banks is the privilege of creating money and making monetary policy. Does that clarify somehow?
Not really, because what you're basically saying is the banks have to have 100% reserves. If a bank can loan out $50 based upon having $5 in its vaults, it's creating money. So what you're basically requiring is if a bank has $50 in its vaults, it can loan out that $50 and not a penny more. And basically that strangles the banking system. It becomes totally ineffective, and it will never happen in any capitalist country on planet Earth because the people who control those banks aren't about to let that happen. I mean, because the whole basis for their economic existence is creating more loans than they have reserves. And so I mean, this is a sort of pie in the sky fantasy land that I don't understand what the relevance is, because there's no possibility of it coming into existence.
Yeah. I mean, we might have a fundamental disagreement here. We will not be able to.
Yeah, I'll stop.
Yeah, but at the same time, I mean, one thing that might be interesting for you to look into is non-bank financial institutions. We have a lot of them, and they function, on 100% reserves. Yeah, because that are not able to generate money. They play a hugely important role in our current monetary or in our current financial system. They work too, right? What we propose is that banks become like them, basically. So I think there's a lot more realism to this proposal than you do, but yeah. Maybe we leave it there.
I'm looking for. There's three people with their hand up. Actually, now 4 people. But I want to go back and answer that question that Andrew has brought up. Is there another take? I have one, but I would like to hear it from somebody else. How does a future sovereign system look? That's one way or another, 100% reserves, as Irving Fisher wrote the book, 100% reserves. Does somebody want to respond? Is Nick or Hobart or Richard or Stuart? You're the ones who are on the queue. Anybody? If not, I'm going to make a response. Oh no, Nick's raising his hand, so he'll go first. Nick.
It's unfortunate that we don't have Jamie Walton with us today, because he wrote a wonderful 2-page paper on transitioning to a sovereign system of money, which would be the Need Act, which was put into Congress and ignored in 2011. And the deposits that are created in the banking system of assets and liabilities, with the loans, that's the money that's created. They're called deposits there. Those deposits are extinguished as we make our repayments on our mortgage or our car loans or whatever it is. And as the loan is completely paid off, that money's extinguished. It doesn't exist anymore. In the sovereign money system that was proposed in the Need Act, which is what the American Monetary Institute supports, that those deposits immediately upon creation of the act, overnight, immediately become the property of the federal government as what we would call U.S. money. And as the loans are repaid to the bank gets to keep the interest. These are the loans that have been made in the bank-created debt money system before the change. But as these loans are repaid, the bank gets to keep the interest, and the principal, instead of the bank extinguishing it, that belongs to the government, and that is shipped immediately over to the government in what is called a revolving fund. And that revolving fund then is used to make loans to banks in the future that want to loan out money. Does that explain it?
I would.
Go ahead.
Yeah, Andrew may be quiet there for a moment, but
No,
he's on mute, I think. But
no, I can hear you.
Oh, Andrew, did you have a comment on it? Because we understand the difficulty, especially in grappling around such a huge idea as the banks not being able to work on fractional reserves. But that's what we're contemplating, how that can be done. So for instance, if a depositor comes into the bank, you can ask that depositor, "Oh, thank you for depositing your money here." If you, and I'm just giving you a Stephen example. This is not an official one, but I'm just giving you a hypothetical. And it would be, you want interest on your deposit? And if the answer is no, I just want it safe, I want it to be a demand deposit in a checking book, there might be a little fee and there might not be any interest. maybe slightly so, but in my system of thinking, or in my little utopia, I would say no. If you want high interest, well, then let's go back other people's credit cards. It's an unsecured loan to people, basically. And that's the best rate we can, and we pool it together, et cetera, et cetera. If you want to earn medium interest, maybe you want to back mortgages. Maybe if you want to, low interest might be commercial paper, at a lower interest rate. But it would be a relationship between and there would be no need at that point for FDIC insurance, because it would be a real investment, and the bank and the depositor, the bank would truly become a real intermediator between the depositor and the borrower in some newer system. And there's different ways this can happen. There's peer-to-peer lending platforms that, I'm forgetting their name, but at the end of banking, there was a book by two bankers, by the way, who wrote that. And so there's different systems for thinking. And why we are so concerned about this is, to use the technical term, we want to try to move seniorage, or the first use of money, rather than banks being able to lend it into circulation and keep doing so, and therefore sort of control money coming into circulation. We want to give that over to a public administration that's doing it for the public good first, not for private bankers. And when we read history, we can read repeatedly how that seniorage got into the hands of kings and queens and Caesars and other government entities before that. And we feel like we're out of balance now. And there's a few in our world that get it all in the banking system, and the many get very little. So that's my personal take. And I'll leave it to, let's get some other questions in for Georg. Hobart, you're next.
I'll hold off responding until we hear the other questions.
Okay.
Well, I might take you up, Andrew, your maybe initial line of questioning. First of all, Georg, that was a wonderfully constructed, very clear, beautiful presentation. With, for us, of course, very nice conclusions and results in this exercise. But of course, we're thinking about, okay, how will it stand up to alternatives? You talked about free banking. That would be the ultra-libertarian alternatives. But in our circles, there's also the idea that monetary reform, sovereign monetary reform, is very good, because it might be a step towards socialism or even communism. And so I'm thinking, and here I'm thinking also about the situation in India. So what I'm thinking is that to compare the sovereign system with a system where not only the money supply is nationalized, but also the banks. So it's not full communism, it's not socialism, but it's like, taking over the whole banking system by the state. This was done by Indira Gandhi in 1969 in India, and it had actually really good results. And even the opposition and entrepreneurs were very happy with it, because she pushed the whole banking system towards serving more people in India itself, because it was a little bit of a limited system for the middle class and of course for the upper class, but not for the so-called unbanked. So for many, many years, that system as a state-run system worked very well. At a certain moment, again, it got into trouble. Too many bad loans were created, too much politics was played, there was too much cronyism, nepotism, outright corruption, fabulous fraud stories that if you bump into them, they're good for movies. So now they are changing again because they find out, okay, now it's not that good. So they are merging the public banks, and they're letting private banks and foreign banks come into the system. But I was wondering, indeed, if you would do your exercise with finding, the pros and the cons, and especially, and this is what we have to keep in mind, the way that things can be calibrated towards a good result. Even if there might be a bad result in the beginning, there's always this way, of course, that if you're aware of it, you can calibrate the system towards a better result. So did you think about, a system where it's kind of socialist, communist, or where at least the whole banking system is nationalized?
Yes.
Because God forbid, maybe that comes out better than the sovereign monetary system.
Yeah, thank you very much for the question. That's really a very good one. I've never been asked that, although I've presented this thing like a lot of times. So one thing that comes to mind immediately is that John Rawls was always positive as an option, as an optional sort of economic setup for the society of having democratic socialism. Yeah, that's sort of, he thinks of two economic systems that are compatible with his system of justice and fairness. One of them is democratic socialism, and the other one is property owning democracy, it's called. Yeah, in democratic socialism, he says the means of production are socialized, as far as I remember, but people retain the freedom of job choice. Right. So this is presumably compatible, it would seem, with a state-steered banking sector or a nationalized banking sector, as long as it's guaranteed that those who want to become bankers, they can become bankers. As long as we don't restrict people from this particular profession. That's at least my guess. Afterwards, one might look into this more closely, which I haven't done, so I'm not 100% sure, but I think it would be compatible. And then another thing that comes to my mind is that apart from wholesale nationalization, there's a lot of other ways, of steering banks and what they do. Yeah, so I don't know, in Europe after the Second World War, we had a lot of interference with bank business from, the central bank that was sort of meant to, have some kind of credit guidance, basically, sort of identify certain priority sectors that, need lending in the economy, and, tell the banks, well, lend to these sectors preferentially. You'll need lower, reserve requirements for loans to these or whatever. So there's many ways that are less sort of intrusive than wholesale nationalization that can steer banks into a positive direction and away from pure profit maximization. They've not been used ever since the 70s, at least in Europe, I think. But I think that would be a way to go in the future, especially considering the climate emergency and possible ways of responding to that, or at least stopping banks from contributing to the destruction of our planet by funding fossil fuel stuff, basically. Yeah, so that's a really important topic.
Yeah. No, thank you. And the idea of credit guidance is, of course, another alternative. Because the system, even if there's sovereign money, might not prevent banks still to speculate with the money that they do have, and wreak some, other kind of havoc. But what Nick was referring to, and this is get maybe too technical, so I'll leave it on the side. But the federal revolving fund can be used with credit guidance. It's not explicit in the Mead Act, but I think there's a possibility that it can be built into it. I would be in favor of it. That if the revolving funds go back to the banks, that there are some conditions attached to it, how they will use it. Anyway, thanks for the answer and for your good work. Congratulations.
Okay, thanks for the conversation. That's been really interesting.
Yeah, just adding on to Nick and Hovert, the revolving fund too might be, some of it may go into government, or 25% of it may go back into the states towards local funding of projects too. It may go down to municipalities perhaps. But let's go to the next person. I'm sure Carol can make it, but then I want us to, we're going to need to turn gears towards the next presenter. Carol, you're on now.
Okay, it seems to me like one of the big crises we're facing is a loss of sovereignty, local sovereignty, state sovereignty, national sovereignty. And it's not just here in the United States, but it's throughout the world. And part of the reason is because money has always been a tool of empire. And by enabling corporations and wealthy entities to go into other countries and steal their resources, exploit their people, that's one of the reasons we have this incredible concentration of wealth. So that's that's where I have a problem with your model. It's like, okay, if you have a closed system, but we don't anymore. It's I mean, they've created all these new laws so that everyone's lost their sovereignty, and you have this tremendous exploitation and the sucking of money and wealth and resources to fewer and fewer hands. People have lost control over their local places and their states and their countries.
Yes, that's truly correct as a diagnosis of the present. Yeah, it's really unfortunate, this assumption of a closed society in the Rawlsian framework. I just have to stick with that for theoretical reasons, and it's not evident how removing this assumption would affect the conclusions that I draw. Yeah, so I'm not very sure what I can say in reply. In a way, I think the kind of work that I do still has some kind of importance in so far as it shows us some kind of ideal, yeah, even if for a different world, but it does show us that there's some reasons that are weighty reasons, wherefore we don't want private people to issue our money. So these kind of reasons that I can give based on this philosophical framework of thought, they hold true independent of this assumption of a closed society. Afterwards, when it comes to the question of how to regain sovereignty for a country that is subject to the need for US dollars in order to conduct international trade, that's very complicated. I think one sort of promising idea is to create sort of regional currencies, right, such that countries, for instance, in East Africa can trade amongst each other without having to have US dollars in great amounts all the time. Yeah, but I think some of these things are in elaboration, whatnot. An African international bank has sort of started introducing this African trade currency. So that's something I guess we'll see in the next couple of years or decades, and hopefully the dominance of the US dollar will decrease in international trade. Does that somehow help? I think
I mean, it does seem like the dollar's on its way down with BRICS, but I do see an international crisis ahead and a power vacuum. So maybe countries will be able to reassert their rights, and people will reclaim their sovereignty on whatever level they can.
It's possible, yeah. Some light in any dark story, no?
Thank you, Carol. We do have time real quick. I think it's Patrick. If Patrick can come on for a quick moment.
Oh, thank you very much. So you've answered my question, because the question of whether a country can go forward with monetary sovereignty and implement a Rawlsian system really seems to depend on its ability to survive the inflation and the currency devaluation And so I posted in the chat the discussion about this amongst the African countries led by the professor who's on the podcast, who's just done a big report on how African countries can become independent enough to achieve monetary sovereignty. And he does adopt the regional currency model, but he also says policies have to be implemented to achieve food and energy independence from the global market. And without that, they end up in debt. And so it does seem to be that the Rawlsian system fails us all the way down the line because Rawls took the assumption of a closed system. I was in his graduate seminar in college, and I can tell you that he took a lot of shots for assuming there's no international economy and wishing away 300 or 400 years of global capitalism. So I just wanted to give the speaker one last chance to try to salvage what is basically not helpful or useful in any way to model what we're trying to get to, because if we don't look at global capitalism as a world system, we can't acknowledge that only 5 nations, maybe 6, have monetary sovereignty, and the US is probably not going to go first in terms of what's being proposed here. So doesn't that just strand Rawls's system of thinking? Even though I like it, it's a nice imaginary idealistic Kantian type system of thinking, it's really irrelevant to facts on the ground. And I just want the speaker to respond to that point of view.
Thank you very much. I appreciate the question. So I think, apart from, proposing the one big solution to everything, or to the question of which monetary system we should have, like Rawlsian political philosophy can be helpful in identifying reasons that we might bring into the discussion for why we might want to have a sovereign money system. Yeah. And although, like the assumptions that we make in Rawlsian theorizing might be unrealistic, and, our reply to the question which monetary system we should have might not work, in a system where there's international connections, we can still identify, or we can still rely on the Rawlsian system to identify certain reasons which will be relevant and pertinent even under other conditions. Yeah? So I think what I try to identify in this discussion of mine, that private money issuance is a problem with regards to democracy. This holds true whether or not we have international connections, and that's something I guess the Rawlsian system and theorizing within its assumptions can help you see and can help you argue in the public forum. I hope that sort of helps. Thank you. Thank you very much for the question. Much appreciated.